Hi, today we are going to take a look at a TSMC, also known as Taiwanese Semiconductor Company, to see whether it's still a buy after the recent 50% rally it had. So TSMC is a contract semiconductor manufacturing company. What this means is that other companies which cannot manufacture chips but can design chips, design their own chips, then contract TSMC, and TSMC will actually manufacture the physical chips. According to their page, they have 532 customers worldwide, and among these customers, you probably recognize some of these names like Apple, AMD, Qualcomm, Nvidia, among others. So Apple, for example, makes all of their physical chips via TSMC for their iPhones and Mac computers. So as you can see, TSMC is one of the few companies that can design these very advanced nodes like the 7, 5 and 3 nanometer nodes. These are the nodes that go into smartphones, CPUs, GPUs and any other applications where either power efficiency or computational power is very important. If we look at the revenue per node, we can see that almost half of their revenue comes from these advanced nodes where very little competition exists, so it can guarantee high margins for these kind of nodes. TSMC is also leading the race in the semiconductor race. They have the 3 nanometer node already shipping in 2023, while Samsung is just starting the production and Intel will go production next year. But competition doesn't stand still either, so they are spending a lot of money to actually create new fabs and create new nodes. So if we search for Intel, for example, they just recently went on a spending spree to try to catch up to these advanced nodes and also increase their capacity to manufacture these nodes. So you can see a lot of spending recently. Samsung also have a lot of spending as well, and they are trying to catch up to TSMC. However, the semiconductor space as a whole is increasing, so even if they were to lose their leading semiconductors, that doesn't mean that they will not going to make money. There is still plenty to go around, so this increase is driven mainly by two factors. One is that in the developed world, we just simply use more and more chips. For example, these smart devices, and it seems like we need smart from everything, even furniture, so you can get smart chairs. However, maybe a more important factor here is that a lot of people will going to escape poverty. So in the next 10 years, it is estimated that 1 billion people will leave poverty and join the middle class. And as these people join the middle class, they will going to use more chips themselves. So they will have smartphones, PCs, even smart furniture. So let's move on to check TSMC's long-term stock fundamentals. So if we search for TSMC, we can find it here in the list. And we can immediately see that the revenue has been basically continuously growing, sometimes a little bit faster like here, sometimes a little bit slower. This depends somewhat on the semiconductor cycle. We can find out the actual revenue growth rate by searching for it, and we can see that, for example, till today, in the past, let's say 10 years, it has grown about 15% per year. This growth is not in US dollar, but in new Taiwanese dollars. And since 2003, it has grown about 13% annually. This chart often can be a little bit misleading, especially if the last report, the growth rate is very much high or below their average, so it may be better to use this chart below. This prints out the growth every X year interval, where you can select the X based on this slider. So for example, if I point to 2020, then this will that this shows that there is about 11.7% annualized growth between 2013 and 2020. And we can see that indeed it's a very impressive growth, so about 12-ish%. If we check every 10-year interval, we can see growth about 11 to about 13%. If we check the lower interval, we can see these large holes in the revenue growth. These represent the semiconductor cycle, basically. However, it's good to see that even in these lower, slower periods, the revenue is still growing. So let's get back here to the charts, and we can see net income, basically the same story. It's continuously growing, though I would like to point out that this large growth in the very end is exactly coinciding with the COVID stimulus money that hit the financial market. So I would be a little bit careful to extrapolate this part of the curve, and these are more the representation of what this company usually can do. EPS in line with net income because they are not changing the share count much. Free cash flow, it's not so nice as the EPS, but the reason this is not so nice is because this company has to reinvest a lot of their cash flows into developing these advanced nodes. Margins, nice and consistent. Net margin, same thing, though again there is a little bit of increase here in the end, which is the result of the stimulus money more than the organic growth of the business. P/E ratio roughly in line now with the long-term P/E ratio. Trailing peg ratio, so the trailing peg ratio is the P/E divided by the 7-year annualized EPS growth in percentage. So for example, if a company is growing at 20% and have a 20 P/E, then the trailing peg would be 1. In this case, the trailing peg is only 0.45, so very impressive result. Generally, I would consider anything below about 1.5 a good deal. Altman Z-score, this is a number that represents the financial strength of a company. It was originally created to try to predict bankruptcy, but it's also very good to just get a general feel for the financial strength of a company. So generally anything above 3 would be considered good. This company right now has a 6.6, so very strong Altman Z-score. And as such, they can easily pay off their interest, so their EBIT is covering the interest rate 244 times. So another thing I like here is that their assets are growing as fast or even faster than their liabilities. Very important metric here, return on invested capital. Based on my backtest I did, this is one of the most important metrics to try to find companies that will outperform the market. I would already consider about a 30% return on invested capital very good. However, this company right now has a 49% return on invested capital. This is extremely good and rare to see, especially in large companies like TSMC. Share count, as I have touched on it above, doesn't really change much, so they are not diluting nor they are buying back shares. So not diluting is obviously good, but you might wonder whether or not they should buy back shares. In my opinion, because they have an extremely high return on invested capital, they should continue to invest this capital into more growth. So I do like that they are just not touching their shares. They do have a little bit of share-based compensation now, but it's extremely low, just 0.025. So in US companies, I often see that the share-based compensation per net income is often above 10%, especially in large companies. capex per revenue, so they have to spend a lot of money to develop these new nodes. One thing that worries me is that there is a slight uptrend here if you look at the long term. So right now they are spending about 47% of their entire revenue to develop these new nodes. However, if this trend is continue to grow, that it could eat into their margins in the long term. They are also paying a little bit of a dividend, just around 2%. However, it's a very sustainable dividend. As you can see, the payout ratio is only 32% and 55% of their free cash flow is paid out. And they also increased their dividends, so hopefully they will continue this trend, and then the shareholders will get more and more money for their shares. Those who invested early into TSMC already get a lot of dividend for their investment price. Down here we can see also the EPS growth, roughly in line with their revenue growth, because of course, as we saw above, their margins are fairly consistent, so about 11-14%. There are some semiconductor cycles, but I wouldn't worry about them, especially in the long term, and they tend to even out. And finally, we have reached the bottom of the page where we can see the current price versus the calculated value in history. As you can see, for the most time, this company has been below fair valuation. There was a little bit of uptrend here as the stimulus money hit the markets and it went quite high. Now the price is a little bit below, so we can use the DCF calculator to find out whether it's fairly priced or not. Currently the calculated fair value is very high, but again, this is due to the huge influx of money into the stock market in general. And down here you can see the checks. It's mainly what we talked about already. So let's go up and let's do the DCF calculation. The way this works is that you have to fill out this form, and based on the input parameters, this program will calculate the fair value based on the discounted cash flow model. You really shouldn't touch the revenue and share count. This is what the actual values have been in the last reported interval, but the remaining ones we should definitely fine-tune. They are already filled out with sort of good starting point based on historical value, but we definitely want to fine-tune them. Some of these values have start and end periods, so the start period is what you expect the company to do this year, and the end period is what you expect it to do 10 years from now. And let's start to fill out the net margin. You can find a chart here that can help you fill this out. The blue value is what the historical value has been, and the red value is the projection based on your inputs. So in this case, it is currently historically very high, 42%. However, again, as I mentioned before, this is likely due to the COVID stimulus money. So let's go back to maybe 2017, and this might be a better margin to use in the long term. So 36, 35. So let's go with the 35 margin, and as you update it, it will automatically change the chart. As you can see, it's already changed, and it's now in line with what it has been in historically, rather than the last 2 years where it has been historically very high. Next up, the revenue growth rate. We can use this chart down below. We have already seen this in the previous page as well. So we can see that, for example, every 10-year interval, it has been growing like 11, 12, 13%. If we look at a smaller interval, there are sometimes these semiconductor cycles, and the growth rate is going down. So let's go with maybe 12% right now, and 9% at the end of the period. Share count change. We can use this share count chart right here, and it basically doesn't change, so it's pretty constant, so I will leave the 0 here. Multiple, this is the multiple at the end of the period, basically the PE ratio. I usually derive it based on the end growth rate as well as how important this company is. So roughly I think the PE ratio should be equal to the end growth rate. However, if it's a more important company like TSMC is, maybe it should be a little bit higher. I put in 12 here. Actually, this was the calculated value, and I leave it at 12 because it's an important company. It's still growing 9% annually, so 12 seems reasonable to me. And there is one last parameter here, the discount rate. This is basically representing the growth rate or the expected growth rate. So for example, if you were to buy this company stock $105 today and all of these assumptions are correct, then you would be expected to receive about 10% annual growth rate for the next 10 years. And if we change this value to, let's say, 12%, then we can see that currently the stock price represents a 12% annual growth rate for the next 10 years. And I usually just leave it at 10, so it's easy to compare with all the other stocks. I put it into my watch list. Talking of which, you can just add this company to your watch list and it will save the calculation. So if you ever need to go back, you just click on the calculator button and it will go back to the form you have filled out. Okay, so we have established the fair value here, about $105, which is above the current price, so this company may be a buy. However, as with every investment, investing into this company comes with the risks. So there are a couple of main risks. Let's go over some of them. So for example, China and Taiwan tensions, as you probably have heard about it, they don't have a really good relationship right now. And there is a constant talk about war between the two, and currently it's kind of in a cold war-like situation, so there is no active war. However, if it ever turns hot war, that could be very bad for the people, and since we are talking about the stock, it would be very bad for the stock price as well. Now, TSMC is actually diversifying out from the country and making fabs in Japan, in US, and also there is talk in also fabs in Europe as well. So the next risk is capital expenditure. As you can see, the capital expenditure per revenue is going up over time, and if it is continuing, then in the long term it could eat into their margins. Next up, semiconductor cycle. So semiconductor is a cyclical industry. Sometimes it's growing quite fast and other times it's actually shrinking. If you invest in the long term, let's say 10 years, then this is probably just volatility for you. However, if you invest in the short term, then it's possible that you may buy on the top of the semiconductor cycle and sell in the bottom of the semiconductor cycle, and that is a risk for you. Next up is competition. This is generally a risk for every single company, because if another company comes into the space which have better products or more throughput or lower margins, that can affect the company. In this case, a lot of semiconductor companies are spending a lot of money over the next coming years or decades to try to manufacture more and more semiconductors at more and more advanced processes. So Intel is recently spending several tens of billions of dollars to try to get its leadership position back. However, I don't think this is such a big risk, as the entire industry is growing. So even if the TSMC's share would go down, the absolute value, the revenue, will still be growing, since the entire industry is growing. Another risk could be a fairly low margin of safety, so currently it's just 16%, which means if the company just underperforms a little bit, let's say it's growing 10% and here it's just growing 6%, then it's already not returning the above 10% return we were expecting. So I think TSMC is a good company in a good position to capitalize on the growth of the semiconductor industry as a whole over the next decade or so. Disclaimer, I do have TSMC shares. So thank you for watching and bye.